Well, good morning. Thank you all so much. It's a joy to be with you and a privilege to be with you in Las Vegas. Before we get started, we want to put a QR code on the screen. We're about to throw a lot of information at you, just like what we heard, and we want you to have the chance to look at that on your device. Take that with you when you leave today. We're going to move really, really fast through a lot of this, talking about what we're seeing as well in the energy market and the benefits and the investments that are available. And so we think this is going to be really helpful to you. So as people are doing that, you want to introduce us?
Yeah, of course, Tim, and thanks for that wonderful intro. Like you said, I've been in the business for 20 years, primarily as a petroleum land broker or landman.
Like the TV show.
Just like the TV show. Except you're not going to find me out twisting a wrench anywhere like that. But we've had teams of 1,000 different landmen across the country working in 18 different states, putting projects together for everybody you've probably ever heard of and probably dozens of companies you haven't.
Yeah, if Adam is the landman, I'm the lawyer. I'm sorry about that. I apologize on the front. I'll try to do better with my life in the future. But part of my practice involves representing policymakers, politicians. I'm a member of the Electoral College, and we think that our experience really matches well, especially for this time, as we look at the energy market, as we understand what some of these policies are going to do as they work their way out for investors.
So at a really high level, folks, what we do, we're not out drilling our own wells. Don't look at us as direct energy producers. We are energy finance. We are baby private equity. We'll talk a little bit later on and throughout the whole show at our breakouts and at our booth, why there's such an opportunity for investors like you and smaller shops like us to enter this space like never before.
Yeah, we invest in what are called non-operated working interests, which are what they sound like. As Adam said, we're not operating a well. We think this is the smart way to invest in the energy market because essentially you're serving as the financier for these operations. And as you'll see on the slide here, there's a number of benefits to investing this way. One of the main ones you see in the red box there on the right are the tax advantages, which we'll talk about in a little bit. But again, we're not operating the well, but kind of like private equity does, we're investing in the well in exchange for a share of the production.
So we've talked a little bit about private equity. Over the past 40 some odd years, there's various ways that oil and gas projects have been funded. Back in the 80s when banks actually performed some duties that were useful for folks, banks actually performed most of the financing for oil and gas. That gave way to private equity, all the big guys you've heard of, your BlackRocks, your Raintrees, your Apollos, people like that. What folks are seeing now is private equity has asked to have returns to their shareholders. I know that that's a wild concept, Tim, but private equity is not the, endless supply of capital that it used to be, which sort of creates opportunities for us and for you. So if you look at the map here, these are some areas around the country that no doubt you've heard of. About 80% of the private equity that I've talked about so far goes into the Permian Basin there in West Texas. The rest is kind of scattered out throughout the rest, and it funds both industry giants like your Conocos and so on, and it funds the smaller independents as well. So sometimes it's looked at like, well, we want to follow big private equity into the Permian Basin. Well, that's really expensive, and for individual investors and guys like us, we may not have $100 million just sitting around to go buy a project. So what we choose to do is utilize that experience in 18 different states, and we choose to evaluate deals across the country. That gives you a diversity in not only location, it gives you a diversity in operator, but also commodity type. We think that that's a big deal. We've talked about, or some other speakers have talked about, projections for oil, projections for natural gas. We are also bullish on natural gas, so much so that about 12 months ago, we may not have put together a fund like we did to close out last year with as many natural gas assets as we did. So towards the end of last year, once the Trump administration was going to obviously take over the White House, we decided to add some natural gas inventory to our funds at the very last minute. We did so at good rates. We bought some Haynesville projects. Those are big dry gas wells, just monsters. It's the second largest natural gas field in the country. And that's performed really well so far.
Yeah, so there is a word as we talk about current political and economic trends. It's a nasty word, it's a dirty word. We've already even heard it today. Let's just go ahead and say it. Let's talk about tariffs. And this is the part where we'll move very quickly through a lot of information. So you all were probably like us a few weeks ago now, when this news came out that the president was looking at tariffs on the Canadians and on the Mexicans. And what it seems like for now is that is just a negotiating strategy, that when those countries relented to his demands, we put a pause on them for 30 days. But we saw a real impact on the energy markets that day, as we saw the price of oil go up and the price of oil fall in response to news. What I think that shows is there's going to be, and we see this every 4 to 8 years, as we've already heard this morning. I loved watching those slides as we saw how a new presidential administration, as it comes online, enacts its policies as we would expect it to. And those policies have a few months where they work their way through the market, but eventually the market absorbs those policies and adapts to those policies, and markets stabilize. I think that's exactly what we'll see in the energy market. But probably more important than the word tariffs is the word sanctions, where you see there on the second bullet point under number 1 that the targeted sanctions on Iran and Venezuela and potential pressure on Russia and China are going to be good for domestic production. Obviously, Iran is producing less than they were back in 2016, but as long as we keep international competition out of the domestic market, it only allows us to export more, especially as it relates to liquid natural gas. And we have a willing market partner in Western Europe that wants to buy our natural gas. We have an administration that will allow us to export for the first time. And so we think all of that, short-term instability, whether it's tariffs, whether it's sanctions, is going to lead to stability over the market for the years to come. But that said, as we're people who are looking at deals, we still think that the best pricing is conservative pricing.
That's right. So as we put together our funds, again, a lot of this is math. You know, petroleum engineers, they model these things. We work with them, and we have to choose pricing. What do we think is going to happen in the future? So we look at between $65 and $75 per barrel. We think that's reasonable. We think that's conservative. So that usually hits our models at 70. We think now $3 an MCF for natural gas is probably a good metric, even though you see the NYMEX strip, I think it was as high as $5 and $6 in the coming years.
Yeah, and one last thing that I'll mention before we get away from this. For the first time in a long time, we have a Secretary of Energy, Secretary Wright, who comes from the oil and gas industry. He ran Liberty Energy in Colorado. It's the nation's second largest fracking company. And so we think that can only be good for domestic production, because we have a secretary who will go into the Oval Office and say, Mr. President, that policy is good for domestic production. That policy is bad for production. And again, that will lead to some stability within the market.
So you've heard Tim say stability about 8 times now. I think you're picking up a trend. That's what we want. We're tired of booms and busts, right? That doesn't help anybody. If we have oil at 40, I think what the president said that he wanted to hit 50. Is that what he said? Something like that. Well, if you hit 50, you're going to hit 100. We don't want the yo-yos. What we want is to stay within that stable range of production. So I think our prior speaker talked a little bit about our shale revolution. There was an entire emphasis on drill as much as you can, produce as much as you can. It really didn't matter if that made any sense or not. Just drill, baby, drill. But that doesn't necessarily mean that we were producing the energy that we need, and we're not looking to expand and be inefficient. Efficiency and stability is the name of the game.
Well, and I want to note one thing before you get away from number 1. We cannot leave this room today without appreciating that third bullet point under number 1. Last year in this country, we produced more energy than any country ever in the history of the world. And that's amazing. 13.2 million barrels a day. I can't even understand what that is. But this year, we're projected to beat it and produce 13.5 million barrels of oil per day. And so all of this talk about drill, baby, drill would suggest, we're going to flood the market. We're going to oversaturate with supply. But we're not seeing that, and the projections aren't seeing that, some slowdown in production. Because just as much as we hear drill, baby, drill from producers, We're hearing more, baby, more from consumers, and you've seen some of that presentation today. There are industries that have no limit, it seems, to their energy consumption. Things like artificial intelligence, things like cryptocurrency, even traditional sectors like real estate, where we're from, or even in Texas, or even in other parts of the country that have been decimated by natural disasters, are going to be very energy hungry and very needy for this supply that's going to be produced domestically in the years to come, which I think is only a good thing.
Yeah, you heard Tim say more, baby, more. Well, again, this harkens back to what I said a minute ago. Why do we have this opportunity? Well, because big private equity and their shareholders are asking for operators to do more with less. So they have a budgetary shortfall almost every year. We've talked to some of our counterparts in some very large companies that no doubt you own stock in, most likely, and they talk about their budgetary shortfalls in numbers that would make us all feel very uncomfortable. But it is the name of the game right now. You have to return money to the shareholders, not just roll into new projects. The other thing that we focus on, again, we talk a lot about, what do we think oil and gas is going to do? Again, we're trying to avoid the booms and the busts. Most projects around the United States, most plays, they have a nice break-even point in that $70 to $75 range. Some are less, some are more, but if we stay in that range, we're going to have steady production, and we're going to have a stable marketplace, and it's going to be good for investors and everybody else involved.
Yeah, there's no doubt that, like any investment, diversity is the better way to level out those booms and busts. There's no reason to be involved in one field anymore, in one well, in one opportunity. Instead, what we look for are funds of these opportunities, these non-operated working interests across the country, to level that out. So though there is a lot of up and down in this market historically, one of the things that's always been stable are the tax benefits. And I won't spend a lot of time here because this has probably been talked about by a lot of people that are involved in this space. However, you see here a letter from our accountant. This is the guy who does my taxes and does Adam's taxes. And he summarizes all this to say that tax benefits for non-operated working interests have no parallel in the tax code. They're not found similar in stocks, real estate, or any other investment. So we have some investors that are interested in that as just an asset class because of the returns. We have other investors that are interested in it because of the tax strategy that's available and everything in between. So we think the sector looks strong for the years to come and are really excited about it.
And if you're like me, the tax code is Greek. But what we did is we developed a pretty cool tool on our website. It's free. Go to the website, check it out, play around with this. This is our investment calculator. What this allows you to do is you enter your own metrics, whatever financial metrics you want to enter, and then you talk about investment levels, and it shows you your estimated pre-investment tax level and then your post-investment tax level. This is a collaboration with our CPAs, with our oil and gas teams, so it bakes in the metrics that we look for in our funds along with the tax code as well. So like we said, we gave you an awful lot of information. We tried to go fast and stay in our time. We wanted to leave a little time for you guys to ask questions. If we don't get to you, please come see us in the exhibit hall. Please come to one of our breakout sessions. We'll talk more about the specific funds that we're raising, which we actually launched to everybody today, so that's really exciting, we think. And now, let's open it up for some questions.
Happy to have these gentlemen answer any questions. While you're waiting to get up to the microphone, just so you know, Tim and Adam will have a 12:45 presentation on stage 1 in the exhibit hall after we open at 12:30, and they'll be back here in Champagne 2-3 at 3:40 for another presentation. So if you don't have a question now, you can go into depth in either of those sessions. Let's see. We can just talk taxes if we want, right?
Well, you sure can. I don't like paying taxes.
I don't like paying them, yeah.
I mean, it is almost that time of year.
Y'all like paying taxes? I didn't think so.
No, seriousness though, I mean, that one mention, I mean, again, as we roll into tax season, just briefly, anything that you expand upon later.
Sure, I'll hit on this a little bit, I think. So basically the way this works is the year one tax breaks are substantial. Anywhere from 65 to 95%, depending on what the accelerated depreciation policy is at the time, is dollar for dollar off your earned income, passive or active. We're not CPAs, relax lawyer. We're not CPAs, we're not giving tax advice. So disclaim, disclaim, disclaim. But check with your own CPAs and see how this stuff works. It really is as strong as we just discussed.
Yeah, and the other benefit to it as well is the first 15% of income is actually tax-free, which I'm not, again, not an accountant, but I don't know of any other asset class like that, maybe except for some kind of boring bonds or something like that.
Anybody else? Nobody else?
Thank you all.
All right,
Perfect.
come
Thank you
see
so
us.
much.
Thanks.